Marksman Capital Presence.
Can Apple truly be competitive over the years? Are they still the biggest winner and will continue to do so? So let's dig deeper into the fundamentals. So when we look at the competitive mapping, the base question is that do they have wide economic moat?
Analysis retrieved successfully. Onboarding Striker X now. 3, 2, 1, start sequence.
So when we look at the competitive mapping, the base question is that do they have wide economic moat? And if we look at the smartphone and personal computing companies, I will just map the most relevant competitors. Since Apple is in this consumer electronics and personal computing, over here I picked the top 8 industry players. Then we can see Oppo and Vivo are not public listed, so I can only extract revenues. It is hard to extract net margin and market capital from private companies. The size of the circle represents the market capital, and we can see Apple is the most invested company, all right, in this industry. The vertical axis represents the net margin percentage. We can see Apple being the most profitable champion in this industry. We can see now it's mapped out here 26%, right here, 26% in the net margin. And if you compare that to Samsung, it is the second closest competitor, and it is 50% less net margin compared to Apple. The rest are pretty insignificant compared to Apple. So you can see there's a huge and clear difference, and the rest will be quite fragmented over here. Right. So this is what I can capture for the very most of all the industry players over here. All right. So let's name them one by one. Of course, Apple's number one, and you can see the revenues 2021, and this revenue right here, 378 billion US dollar. It is the same as Malaysia's GDP. Malaysia's GDP is around 360 billion in 2021. So a single company that is actually producing more than a single country. So that's quite impressive, I would say. So then the next thing, we look at the net margin distribution. And this is where I dig out some of the info from Guru Focus, which is also a fundamental website. It gives me a quick snapshot on comparing other related companies in the industry, or even across several related industries. It seems Apple is ranked higher than the 96% of the companies. So this is an indication of a dominant or monopoly business. And you can see that 96% higher, it's ranked higher than the 96% of the rest of the 2,339 companies, related industries, right? So Apple, we can see that Apple is always it's skewed to the right-hand side of the entire curve on the margin. It is the most profitable company. And you can see cash flow is crossing more than 100 billion. So they have a lot to invest, and a lot to invest in the R&D to stay ahead. Innovation is one of the greatest ways to stay ahead of the competition. And they are the masters of ecological systems. When it comes to ecological implementations, they integrate as much devices and applications possible, immersed into consumers' life without even consumers being conscious of overly surrounded by multiple Apple devices. This creates consistencies and convenience for users. So this is a high switching cost model. And if you're comfortable with Apple, you would not likely switch to other brands. So for me, I've been an Apple devices user for more than 9 years, or sorry, it's more than 10 years right now. Coming to now it's more than 10 years, and I don't see much quality problems, and I still continue to use Apple devices. And all of them have consistencies because they are all linked and synchronized to the cloud system. And we have smart watches that monitors your health, that is linked to the smart TV, Apple Smart TV, to iMac, and to all your iPad, all your devices, they have the same synchronized platform. All right, so this is a very good practice of their business, and you can access any of your devices into even other apps as well. So that's why no wonder their cloud services and apps are growing quite consistently, or actually very consistently. Now, if we look at the patterns of the past years, how iPhone or Apple has been launching their models, and here we have a roadmap uh, since 2007 until 2021. This is a complete roadmap that shows us what are the models that has been launched, and this is a very recognizable pattern here. Almost every year they launch new models with new features and enhanced experience. Right? So almost every 1 or 2 years, when Apple launches some new models, after some time they would stop or they would actually prevent the iOS software platforms from supporting the old models. If you haven't realized that, this would prompt the consumers to buy new models, even though the hardware is still working. All right, that means it's still functioning. But when it comes to new iOS software platform, then it might slow down the old iPhone or completely obsolete. So, for uh, if we look at, let's say, for instance, iPhone 5, how long would it last? So here, how long would it last? It will last until the iPhone 11 launches, right, which is here. So it will last for several models. When there's launching of iPhone 6, we have 7, 8, and 9. This whole range right here, all right, it still lasts for 6 to 10 iPhone. Then when it comes to iPhone 11, then the iPhone 5 is going to be obsolete. All right, so this is how it has been very consistent. And if we look at the revenues characteristics, every time Apple launches their new devices, hardware devices, then it creates fresh new waves in their revenues, in their balance sheet or in their net income statements. So we can see that smartphone and smart devices have more cyclical behaviors, but the apps and the cloud services are steady growth segments that are compensating for the cyclical behaviors. So it averages out the revenues quite nicely, right, over the years. So yeah, this is quite astounding to know. And okay, so now let's go to step number 5 and how their debts structured. Are they conservative? And over here, we need to look at a few angles to evaluate financial health of the company. Does it have more assets than liabilities? Is the debt structure conservative? There are 4 metrics that I consider. So over here, the current ratio is about 1. Debt to equity ratio is about 1.71. Debt to servicing ratio is about 2.4%. Then debt to EBITDA ratio 1. So what does all of this meant? And ideally to be exceeding or not exceeding what kind of values right here. Let's dive in a little. Okay, so the very first thing I look at is the current ratio has to be more than 1. That means you need to have more asset than liabilities. Right? In order, if anything happens to the business, then it can always pay off with the assets. But I mean, pay off the liabilities using the assets. So the assets has to exceed. So in this case, if we look at the short term, or we call it current assets, they are about 153 billion versus the liabilities about 147 billion. Of course, if you equate that, it will be more than 1 right here. So currently the debt to equity ratio is about 171, which is way above 50% of the acceptable leverage. So this is the leverage. Why are they leveraging that much? Or why the equity has dropped so much and they have not picked up so much debts? So these are some of the characteristics we need to study. If they're so leveraged, are they able to service the debts accordingly? So let's look further. And well, I've extract all these from the balance sheet on the latest TTM numbers. We can use tracking 12 months or 2021. So if we look at the debt servicing ratio, we know that before we look at this, the debt to equity ratio it's 3 times higher than the baseline. So besides, 50%, it's 171% leverage. So we look at the net interest expense over the cash flow from operation. So cash flow from operation. So if we actually take these two metrics, right? I'll take the latest tracking 12 months to see, uh, what is the debt servicing ratio like. So it's about 2.4%. The acceptable debt servicing ratio is less than 30%. So just like taking up house and personal loans, if we apply more loans, the banks need to see if we can service our debts consistently if we take up more loans. If the bank sees our debts are already taking up 30% of the applicant's income, monthly income, then they will see that it's risky to lend more. The applicant may fail to service the debts. So for Apple's case, it is only 2.4% compared to the cash flow from operation. Very negligible figure. All right. So another thing to look at is the debt to EBITDA. Debt to EBITDA have been trending downwards, and this metric is important for us to see if they can pay off their debts with their earnings within 3 years. 3 years is the benchmark, and it seems that they can pay off the debts from their net income within 1 year. Excellent ratio. So this is the ratio 1.01 debt to EBITDA ratio. All right, so this is quite straightforward. Then, of course, when you have good fundamentals on the cash flow, the revenues is growing, high switching costs, some monopolistic characteristics or dominant, all right, to be exact. Then we look at the valuation. Well, valuation is about intrinsic value. Is the business good enough for us to accumulate more of the shares? So right now, here we can see this is actually 19.2% overvalued. It has been actually almost 4 years. I have been waiting for a long time to own some shares of this business. So right now, I've not bought any. All right, so it's still quite a high price for me at the moment. So it's quite expensive for me to buy some. So, but the intrinsic value is not always the alpha and omega to me. So as long as it is undervalued and also it comes together with confluence in some technical patterns, chart patterns, then I would likely accumulate more. So yeah, Morningstar is one of the most reliable websites that I actually use to actually analyze the values of the business. So there are a few sources. Even Guru Focus and Simply Wall Street, they have some of their own valuations. And always remember, it is not the alpha and omega, right? For me, at least. So if you look at chart patterns, this is the latest chart pattern from last week. And of course, if we look at chart patterns, the previous two big corrections is about 38 and 34%. During the pandemic, it's about 34%. Then it rallied quite a lot from there. It rallied almost 3 times from 60 to 180 on this wave right here. 180% gains from there. So there's quite a lot. So this is almost time. It's a long overdue correction, and right now it's about 26% correction. And the intrinsic value from Morningstar is still 130 below. So it's below this dotted line right here. It's in the yellow zone. I would really prefer, ideally, to wait to buy some shares if it goes around 100 or below, right? So I buy in tranches. So if it's let's say for instance, right, if it is 110 within this yellow zone, 110, then I would buy maybe about 33%, or can be divided in 3 or 4 times. Then if it is like 100, then I will buy another 33%. And if it is 90 or lower, then I'll buy even more. Like if you have like 3,000 USD allocated maximum for this stock right here, then at level 110, then we accumulate around 1,000 USD, for instance. Then if it's 100 and it is 100, then another 1,000 USD. All right, 1,000 USD. Then if it's 90, another 1,000 USD. All right. So all these three, then each of them it's about 33%. And the more we accumulate, averaging, if we average down, the lower the average price we get, because we may never know how far it gets to the bottom. Okay, we may never know exact bottom. And right now, what I see is this. So there's a huge flush up here, and there's a huge flush up here. So, and there's also in between here's waving down and flushing upwards. So here's a false top, what I will call it a false top. And in weekly candles, there has been a lot more tails. All right, so long wicks upwards. So there's been a lot of distribution right here, a lot of rejection going upwards, distribution patterns right here going downwards. So there's a lot of red candles and a lot of upper wicks right here, and this is likely failed to hold if in this case. So it's about it has been about 26% correction from here to this part. I would, and at the same time I can see that these moving averages are far apart from one another, and I would like to see this price to go down even further before I start accumulating some of these areas right here below 130. Okay, so yeah, around 50% correction or more. So yep, so that's so far from me on the technical part, and I would like to end this presentation right now. So thank you for your time. Happy trading and investing. Striker X here, signing out. If you like this video, please hit the subscribe and like button, and also notification button if you like to get more of these videos, and we will provide the link below in the description column.